Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's 164th CP program organized by AASB of ICI for this council year. I'm pleased to share with you that today is 164th program in the form of the webinar we are organizing, and the topic is SA 250, that is the consideration of laws and regulation on the audit of the financial statements. And in order to tackle this very important standard, we are having with us very respected CA Govind Ahuja ji. So on behalf of AASB of ICI, I extend my warm welcome to you, Govind ji, in this AASB platform. I also welcome all the participants of today's webinar. We are having with us CA Gaurav Maini ji. I also welcome on behalf of AASB of ICI, Gaurav Maini ji as the moderator of today's webinar. And thanks to giving you for your kind consent to moderate today's webinar. Welcome to you, Gaurav ji. So, Honorable Chairman Sir and Vice Chairman Sir both are stuck up in another meeting. So, I am taking this liberty to start today's webinar and request Gaurav Maini ji to please start the proceedings of today's webinar. Over to you, Gaurav Maini sir, please.
Thank you, Anil ji. Welcome all the participants for today's session on SA 250, Consideration of Law and Regulation in an Audit of Financial Statements. Today we have CA Govind Ahuja ji, who's a learned speaker. He's a partner with SR Bartley Boy and Associates LLP, member firm of EY Global UK. He's a chartered accountant, fellow member of the Institute of Chartered Accountants of India. He's into professional practice, director for SRB Network in India, responsible for risk management and regulatory matters. He has client service experience of more than 25 years performing statutory audits, IPO, other assurance engagements under Indian GAAP and IFRS. He has served range of clients including MNCs, listed companies, entrepreneur-led, equity investees, and professionally managed enterprises. He has sector experience in technology, software products, services, and e-commerce, media, entertainment, logistic, professional services, and manufacturing. He has been a speaker at various ICI events, study circle meetings, and he has been a faculty for internal firm trainings on auditing and regulatory matters. So I welcome sir on behalf of AASB to enlighten us with his thoughts and knowledge.
Sure. Thank you. Thank you. So firstly, before I put my presentation up, I'd like to kind of relay my thanks to the ICA for giving me this opportunity. It's always a privilege and a pleasure to interact with fellow colleagues in sharing knowledge, experience, and more learning from each other. So really appreciate this opportunity. What I'll do is I'll just put up my presentation and then we can get started. Gaurav, if you can let me know if my presentation is up now.
So we can see your next slide as well. So,
okay.
So make it full screen, sir, for the first slide.
Yeah. Let me know if it is better now. Okay. Sorry. I'll try that again.
Yes.
Please let me know if now it is full screen.
Yes, sir. It is completely visible now.
Okay. So, Gaurav, if it's good to start, I'll start the discussion now.
Sure, sir. You can go ahead.
Thank you. Thank you. So, welcome colleagues, welcome friends to this webinar on SA 250 on consideration of laws and regulations in audit of financial statements. At the outset, before I go into the discussion on the auditing standard, I would like to just share with you that, looking at our responsibility as auditors, we are obliged under Companies Act to report on the true and fair aspects of the financial statements. And in doing the true and fair, we need to have the expertise in accounting and auditing. When it comes to accounting, we generally get to the right answer. When it comes to auditing, these standards help us get to the right answer as well. But one of the key aspects of an audit, which we as chartered accountants, as auditors, we get challenged on, is essentially when we are looking at the risk of the unknown. And what I want to kind of amplify this point over here is, it's not necessarily the what is there in the books of accounts, but what is not there in the books of accounts. And when it comes to what is not there in the books of accounts, you always have those procedures on looking at unrecorded liabilities or claims or contingencies. But one of the key aspects which auditors are required to opine on or look at are the various impact of laws and regulations on the in the audit of the financial statements. The As we go through the standard, I think we'll go through some examples around how we see laws and regulations impacting the financials directly and otherwise. And this is one of the most important areas as it comes to, when you're looking at times even the management's role in how the governance of the organization of the company which you're auditing is looked at. So it is it's a very important aspect in our audit. And that's what we are going to spend some time today to, go through the requirements of the auditing standard. I will try and share my experience as we go through the standard by sharing with you some war stories, some client examples. Again, without giving the name of the client, but at least to kind of share with you how we dealt with some of the topics. But if you have any questions, I think there's a framework to put the questions into a chat. So please feel free to do that, and we have time towards the end of the presentation to have a discussion on the question and answer which you may have. So with that, let's get started. So what I would try and cover today is the following sections. So introduction of the standard. We'll cover the objective and definition. We'll cover management's responsibility, followed by auditor's responsibility. And then we go into the reporting aspects and looking at some case studies, and we'll have a summary towards the end. I think one of the important elements which we keep re-emphasizing and emphasizing when we talk to regulators is that there's a difference between the responsibility of the preparer and the responsibility of the auditor. And that is why it's important for us to understand that when you're looking at compliance of laws and regulations, it's the management's responsibility, which is the primary responsibility, and for those charged with governance. Whereas when it comes to auditors, it's about how we interact with the management and those charged with governance to ensure that they have done appropriate compliance with laws and regulations. It's a very important aspect. And when we are working with in our audits, more often than not, it almost because we try and work back with the companies, we at times have to draw a line between what is management responsibility, what is auditor's responsibility. So it's important that we are always alert, especially as it relates to laws and regulations. And why is what we'll discuss in the presentation today. So we'll quickly go through the introduction, scope and effective date, and effects of laws and regulations. So scope and effective date, again, this is a very old standard. SA 250 deals with the auditor's responsibility to consider laws and regulations when performing an audit. The standard does not apply to other assurance engagements in which the auditor is specifically engaged to test and report separately on compliance with laws and regulations. So this is essentially for use when you're issuing an audit opinion on financial statements. So and largely coming under SA 700. So that's what this is about. This standard was effective from 2009 onwards. So it's been now almost 15 years since the standard is already in operation. Effects of laws and regulations. I think the effects of laws and regulations, they vary significantly from entity to entity. We are the laws and regulations to which entity is subject to is constitutes the legal and regulatory framework. That is the aspect which is coming through from an audit point of view. So some laws and regulations have a direct effect on the financial statements. And, we are very comfortable in auditing a tax provision or GST balances, at times customs duty. When you're looking at labor laws, we also consider looking at the compliance for a provident fund or ESIC or a profession tax, or for that matter, we may also look at the TDS compliance, which again, under the Income Tax Act. So all of these laws which impact the company, they generally have a direct effect on the financial statements. And some of the possible effects which you may also get to in an audit would be looking at the litigation. So if there's a non-compliance with laws and regulations, there could be impact of a litigation and litigation cost, not only litigation cost, but also impact on litigation, which could be possibly be an order against you, against the company. There could be fines, there could be penalties. I think, we understand that if there's a delay in payment of tax, there'll be interest implication. In some cases, there could be also a penalty coming through on that. There could be damages in case there's a regulation which provides for regular damages to be claimed. A company could be subject to damages as well. There could be sanctions by regulatory authorities. These are financial sanctions, and this we have seen at times come through. Say, for example, if there's a securities exchange non-compliance for either a company or a mutual fund, there could be a sanction by, say, SEBI, and there could be a financial sanction which could be a fine or a penalty in a way. There could be cancellation of a contract in process. So if there's a non-compliance laws and regulations, then there could be a covenant that the contract could be cancelled. So there could be a direct impact on the financial statements if the contract is cancelled. There could be inability to recover contractual costs. So again, all this comes through as a direct impact, because what happens is that when you're looking at the contract and you can clearly see a direct impact on your performance of the company or the assets and liabilities. Loss of tax deductions. So in your tax computations, if you have a penalty being paid, then you may not get a deduction for that. And likewise, if there's a payment made for, say, an illegal act, that expense could be disallowed for the purpose of tax computation. And lastly, assessment of tax penalties. So these are generally, from my experience, I have seen we generally have a level of comfort when it comes to, looking at laws and regulations which have a direct impact on financial statements. And that's something which we are pretty much comfortable doing given our experience of auditing numbers. But if you were to kind of now change the gears over here, there are other laws and regulations which are to be complied by management. And as I said, the primary responsibility of compliance will remain with the management and the company. Or it could be under the provisions under which the entity is allowed to conduct its business, but they do not have a direct impact on the financial statements. This is an area which I call it the risk of unknown, or rather risk of unknown, but we should be asking the right questions to get to the right answer. So what are the examples for items which are coming in this category? This could be a license which you've taken from, say, a government and under the government regulation, and the license could be impacted. It may not have a direct impact on financial statements, but your license could be revoked. Likewise, there could be loss of a significant business relationship. There could be loss of impairment, because if your business is impacted or your going concern is impacted, you could also have an impairment risk coming through. There could be a non-compliance FDI policy. There could be non-compliance sector regulations. I think banks, they're subject to RBI regulations and guidelines. So the non-compliance of the RBI guidelines will constitute again a no-clar out there. Chemical companies, there could be laws relating to how they manage their waste or how they manage their raw material. So in these companies, laws and regulations have a very important bearing in terms of compliance. We would look at purchase, sale, inventory for a chemical company, but these companies where they have their processing plants or when they're selling their goods, when they're transporting their goods, they have lots of requirements as to how their businesses are managed. That is what is the important aspect related to laws and regulations in specific industries like chemical. Likewise, labor laws. I think labor laws, we spoke about the PF, ESIC compliance. There is more direct in terms of financial impact. But there are also other labor laws. For example, can you have your workers working for more than a stipulated number of hours, say in a factory setup? So there could be labor laws which may come into play, and some restrictions around how many hours can an employee work. Then there could be rules around if you have a certain number of employees, then what is the various health facilities you have in that unit. If you have X number of employees, then do you provide them transportation to go back? Likewise, if you have diversity in your company and you have female employees, then do you have appropriate facilities for their transportation in the evening or at night or at odd hours? Those are various aspects of labor laws which also become very important. Now, again, if I reflect back on our audit experience, we would typically look at a bill coming in from a transport agency or the accounts which the payments which get done, but we would not necessarily look at how these laws, which may not necessarily have a direct impact on the financial statements, are addressed. So that's what I'm trying to kind of clarify, that this is a very important area which we should be aware of, and we'll go through the process of how to address the audit part of it. But the very important point is that the effect of laws and regulations could have a very big impact if at all they are not addressed properly. And lastly, environmental regulations. So if you see the second bullet point, I think we're talking about over here that laws and regulations may have a material effect on the financial statements or a related disclosures. So it's not necessary that all the time there could be a debit to the P&L or a charge, but there also could be possibly a disclosure requirement. Maybe it's a contingent liability disclosure, maybe just a disclosure which is for the users, readers of the financial statements. But there also is important that if the non-compliance has a material effect on the financial statements, it may have wider public interest implications as well. It may create harm to investors, to creditors, employees, or a general public. So, one of the examples which comes to mind is that, in case you have a perpetration of a fraud resulting in loss to investors and breaches of environmental laws and regulations, these are examples where you could have a larger impact and not only impact on the company. So, when we're looking at audit of financial statements, we generally look at the impact on the company's financial statements, but some laws and regulations could have an impact beyond the financial statements of the company as well. And those are the examples given over here. So what I want to kind of pivot the discussion now is on what are the requirements of the standard, but it's important to understand that direct effect is generally easy to kind of get through the audit process. But when it comes to those having indirect impact, we have to be far more vigilant and diligent in being able to address the issue in terms of compliance. Coming to the objectives and definition, these are the objectives of the standard. The objective of the auditor is to obtain sufficient and appropriate audit evidence regarding compliance with provisions of laws and regulations generally recognized to have direct effect on the financial statements. We are also required to perform specified audit procedures to help identify instances of non-compliance with other laws and regulations. So direct is quite straightforward because we have to opine on the accounts, but we also have to kind of look at the other laws and regulations which may have a material impact on the financial statements in terms of accounting or disclosure. And lastly, why this is important is how do we appropriately respond to non-compliance with laws and regulations, which we identified in the course of the audit. So once we have a good understanding of the laws and regulations directly and indirectly, we have to then see the audit response to that by designing audit procedures. This is a definition which we have in the auditing standard. Non-compliance is defined as acts of omission or commission by the entity, either intentional or unintentional. So this is a very important distinction because when we discuss some elements of management fraud, this could be a different answer over here. But non-compliance by definition is covering even unintentional non-compliance, which are contrary to prevailing laws and regulations. It's important that they are pivoted to a law and regulation. And we'll go through the nuances of how we've seen this play out in some cases in the presentation to come. Such acts include transactions entered by or in the name of the entity, or on its behalf, or by those charged with governance, management, or employees. So it should be for the business of the company, and it should be done by the people who are operating the company or those charged with governance. Non-compliance includes personal misconduct related to the business. However, it does not include personal misconduct, which is unrelated to the business activity. So I think we'll again have some examples around this as we go through the presentation. But it's important to understand that personal misconduct is a very different topic, because it relates to behavior of people. So when there's a non-compliance involving personal conduct, the important aspect to see for auditors is to see whether it really impacts the business of the company or it is just a personal misconduct of the person. It could be as simple as somebody who is not treating his juniors in the best possible way. That may be impacting the company's code of conduct, but it may not necessarily impact the business activity of the company, although it may have an indirect impact, right? Because if you have a demoralized workforce, then you'll have a problem with people leaving, or you may have more training required. There could be an indirect impact, but generally speaking, this is the kind of examples which come about when you come to personal misconduct. It does not have a direct impact on the business activity of the company. The important point is that in certain jurisdictions, and why I'm making this point of certain jurisdictions is that today, when we see in the Indian context, lots of chartered accountants, lots of auditors, they are issuing opinions on not only companies that are registered in India, but they are also at times issuing opinions on smaller entities of the clients they are working for in other jurisdictions, be it Dubai or be it UK or be it US. Even though they could be special purpose accounts, but there are opinions being issued. It's important to note that non-compliance with laws and regulations is also known as illegal acts in a number of jurisdictions. So, as and when an auditor is looking at laws and regulations compliance for the opinion which they are issuing on a set of financial statements, they have to be they have to be clear about the applicable laws and regulations in that jurisdiction. So it's not that if you're an Indian chartered accountant, if you're issuing opinion on a company in the UK, you have to be conversant or well versed with the laws in the UK to see whether those laws over there is an illegal act over there or not. Because in that jurisdiction, a non-compliance with laws and regulations could be an illegal act, which could have very different consequences as well. So that covers the definition. I think this is a question which we keep getting many a time in our experience, is fraud covered in non-compliance with laws and regulations, right? And that is something which is when it comes to we call it no-CLAR, non-compliance with laws and regulations, coined as a no-CLAR term. I think when it comes to fraud, it always has different colors, and that's what I was trying to get to. Personal misconduct, whether it impacts the business of the company or it's not, is an important aspect. So how is fraud defined, right? I think under Section 447 of the Companies Act, fraud is defined in relation to the affairs of the company or any body corporate, includes any act, omission, concealment of any fact, or abuse of position committed by a person or any other person with the intent to deceive. So this is the intentional part of it. If you saw the definition under the auditing standard, it covered intentional and unintentional, but in this case, it covers only intentional. And it also talks about with the intent to deceive or to gain undue advantage from or to injure the interest of the company or shareholders. So that's a fraud definition we have. So will necessarily a fraud be a non-compliance with laws and regulations? That question remains. So, at the outset, one can say, yes, it is. But it's also important to understand that did that fraud in a way also breach laws and regulations? So to give you an example, in case an employee, in case there's a fraud where an employee has overstated sales, when you overstate sales, you would also have to overstate your GST, or there could be an issue to do with how the GST compliance came about. Likewise, if you're overstating purchases, then again there'll be the invoices which you're getting may not be bona fide invoices because there was no trade transaction, but you have an invoice coming from the vendor. So again, there could be a GST implication over there as well. So it's important to understand that when you have a fraud, whether it really impacts a specific law and regulation, which has a direct impact also or not on the company. Because this is where we have seen that, at least in GST, we've seen many a time when the companies get invoices from, say, vendors who are not in the business. I think that becomes a big issue. So it may be a fraud issue to begin with, where somebody has done some overstatement of revenue or cost, but it may also extend back to a issue relating to the GST compliance. So it's always important to understand, how a fraud plays out in the transaction, and it all depends on facts and circumstances. So not every fraud could be a non-compliance laws and regulations. And sometimes a fraud could be also to do with code of conduct of a company. And I think we'll go through this in the presentation, but because this is a very unique aspect in terms of corporate law compliance, we've seen that many a time in such cases, companies do resort to taking views from a legal counsel, because it's a very subjective area, and it's a very thin line at times to draw between fraud and non-compliance code of conduct. So this is something which I think we kind of set the stage on objectives and definition. I think it's now important to pivot out to see what we should expect the companies to do, and then we'll go into what is our expectation as auditors, because it's important, as I said, it's the preparers who are primarily responsible for ensuring compliance with laws and regulations. So it's important that the preparers have appropriate processes in place to ensure compliance and appropriate communication with auditors as well. And that's what we'll again spend time now in the next two sections, in management responsibility and in auditor's responsibility. So I think some of these aspects are covered pretty much in the standard. So management, with the oversight of those chartered governance, is responsible for ensuring that the entity's operation are conducted in accordance with laws and regulations. It is the primary responsibility is of the management of the company, and because in a company limited, listed or unlisted, there's also those chartered governance in terms of the board of directors, the audit committees. They provide the oversight for laws and regulations to the company. So management, along with those chartered governance, is responsible for ensuring that the entities operations are conducted in accordance with laws and regulations. And what do companies do, right? When companies are devising their, we call it the entity control frame, entity level controls, the ELC. One of the key aspects of ELCs, entity level controls, is the policies and procedures. So, companies should have appropriate policies and procedures. And those policies and procedures which they would have will cover various aspects of the business. And as it relates to laws and regulations, these policies and procedures should be such which help in prevention and detection of non-compliance. So I think it's important that the company creates this framework. As I said, that in some indirect impact situations, the impact could be very significant. So if the company doesn't have appropriate policies and procedures, then there's a high chance of a non-compliance which would come up. Neither could be prevented or not to be detected. So there could be a high chance to come up in terms of regulatory non-compliance. So what are the kind of examples which we have on policies and procedures? So one is, companies have a compliance function. So they would monitor legal requirements and ensuring operating procedures are designed to meet those requirements. Large companies, I'm talking about listed companies and large private companies, they also at times use external tools to monitor their compliance with legal requirements. So they have various technology solutions available in the market which ensure those companies to track their TDS filings, GST filings, and any demands they get from any regulatory authorities to capture those in those databases. So that is something which many companies do in terms of implementation of technology solutions, but more important is monitoring thereof. So how do companies monitor legal requirements, and how do they ensure that the procedures they have are designed to meet those requirements? So the company needs to have appropriate policies and procedures for that. Second, very important, is internal control. So as we've seen in our reporting on internal control of financial reporting, it's a company's responsibility to look at the internal controls. And in this, having an appropriate design and operating effectiveness of a process to identify the compliance and non-compliance and ensure that it gets addressed as a part of execution is very key. So when a company is designing its internal controls over financial reporting and internal financial controls, which is over the rest of the business, it's very important to ensure that they are appropriate. The policies and procedures cover those aspects also, which help them to come up and detect compliance through their internal controls. So I give the example of the technology solutions being deployed by companies, right, to track their TDS compliance and GST compliance. That itself is also, in a way, a form of internal control, where you would get a monthly dashboard to say, okay, which divisions or which locations in our company have not done their TDS filing. So that also is a part of an internal control system, which gives you early detection of somebody who has not complied with the law and regulation. So these are two important aspects which comes to looking at how transaction-related compliance is done. Third is more towards employee conduct and the code of conduct. So companies should have appropriate processes. They should have appropriate code of conduct, and they should not only be developed, but more importantly, they should be publicized. One of the challenges we see in many companies is that all of them have a good code of conduct, but at times the employees are not familiar with the requirements of the code of conduct. And even if they are familiar in terms of, they may have joined the company or the organization 2 years back, 3 years back, but there always is a constant change to remind, a need to remind people, right? So there has to be appropriate process to ensure that there's enough awareness created by the company on its code of conduct. And the code of conduct, there are many do's and don'ts, but one of the basics code of conduct is that the employee will act with integrity. The employee will raise concerns when they see something wrong happening. These are important elements that the employees should be reinforced with. That they have the ability to ensure that they and the company are working in the right direction. So developing the code, publicizing the code, and lastly following the code. Now, following the code, typically you cannot really track. You can only get confirmations from employees that they have understood the code and they are following it. But when you go through any incidents in the company, for example, there's a fraud or there's suspected fraud, or there could be a whistleblower complaint, or there could be internal audit report, or there could be a compliance monitoring report. Any of these, when they throw up an exception, one questions that does it really impact the code of conduct, or was it just maybe the employee was not focused, or just an error from the part of the employee? Because having a code of conduct also is an important way to have employees be conscious about how they need to kind of behave and act in a company. And I think I've touched upon the last point in my discussion. Ensuring that employees are properly trained and understand the code of conduct is very essential. As we know that, we talk about automation, we talk about digital, we talk about AI. But as we know, as we all appreciate and understand, it is the people who drive a company, right? So it's important that the people who drive the company are well trained and well aware of the code of conduct, because they are the people who take the decisions for the company or on behalf of the company. So I think it's important that company framework is very, very clear. So again, as I said, this is again company management responsibility, and these are some examples I'm putting on. There could be many more, which we'll touch upon as we go through the remaining part of the presentation. These are some of the other examples which we have, right? So yeah. So if you look at the other examples, so monitoring compliance with code of conduct and acting appropriately to discipline employees who fail to comply with it. So if the company sees an exception, they would have appropriate monitoring, and then they would do retraining of the employee or take action against the employee to ensure that the right tone and the message is given back to the people out there. Next point on what management can do is engaging legal advisors to assist in monitoring legal requirements. So just I give you the example that some companies develop those implement technology solutions to track regular compliance. Some companies also engage with legal advisors and outsource the entire function to look at the legal requirements and monitor them. That depends on the size of the company and how the company is working, but that's also one of the ways where we see this happen. Maintaining registers of significant laws and regulations and record of complaints. I think this is very fundamental, I would say. It's again as good as books of accounts of the company. So does the company have appropriate record keeping? Especially if the company is geographically dispersed, having operating plants, has various touch points in the laws and regulations. Is there appropriate knowledge and awareness of the applicable laws and regulations, and then is there a record thereof? And record of complaints is very important because many times when you look at a complaint come through, the complaint could be either genuine, where there's a genuine concern being raised by somebody, or there could be complaint could be frivolous. But having a record always demonstrates how the company's controls are operating. So having appropriate record of complaints and appropriate mechanism to dispose those complaints is something which is again part of the internal control framework of a company. Very, very fundamental to how any company would operate. And again, these are some things which the company can have, right, as policies and procedures. And this is something which the company can do proactively. But if you look at the second part of this slide, instances of non-compliance may be identified by the entity from various other sources as well. I think we, again, living in the social media age, I think we have now appreciated the fact that we also get a lot of information from the external sources in relation to our clients. Company get a lot of information for their business at times from external sources. Some of them could be, whistleblower allegations coming through. So there could be anonymous or a named whistleblower if the company has a whistleblower process where somebody could raise a concern on on a company's conduct. And the conduct could be either business related or not business related. It may have a direct impact on the financial statements, may not have a direct impact on the financial statements, but it could be a whistleblower allegation. There could be information available in public domain. At times, there's a rumor floating around it, oh, this company's revenue is overstated. Even that is actually at times an indicator of that. So the operation of its internal control, I think I mentioned that in case there's a appropriate internal control framework in place, then it should also throw up issues. And internal audit, I think this is a very important check. So although the company may have policies and procedures to drive its transactions, you also need a monitoring function. So internal audit can also supplement that and looking at the monitoring process of the company. And lastly, by management during the ordinary course of business. So I think, this is actually just about being alert. As I said, laws and regulations compliances doesn't come as second nature to everybody. Generally, people focus on value of transaction. But when management is conducting its business, business as usual, I would say, they should be alert to anything which could result in a non-compliance of laws and regulations. And many times the companies managing themselves pick up issues when they are looking at their processes, when they're looking at their approvals. I think it's also somebody who is more alert towards this aspect. It depends on the responsible person for that function to pick up that issue. But these are some of the ways where management can prevent and detect non-compliance and be open to all sorts of information which help them to understand where there could be a potential non-compliance. So this is about management responsibility. So I think we covered the objective and definition in the introduction. Now we covered management responsibility. We'll now pivot to our responsibility as auditors. I think that is what this standard is about. And I think with level setting the background which I gave, we can now go into what we are required to do. And again, because this is something which is quite can become a very big area for us, I think I'll just probably share with you some of how we've kind of navigated some of the complex situations we've come across. So, auditor responsibility, I think this is quite straightforward. I think we all understand this, that an auditor is responsible to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether due to fraud or error. Auditor has to take into account the applicable legal and regulatory framework. The standard is designed to assist the auditor in identifying material misstatement due to non-compliance laws and regulations. And I think it's important to note that this is something which is, as I mentioned, it's a little unusual because it's off balance sheet in a way. Owing to the inherent limit of an audit, there is an unavoidable risk that some material misstatements in the financial may not be detected, even though the audit is properly planned. I think we know this that because of at times we may be doing because of sampling, or at times because we don't do the entire population of the transactions. And we are not there when the transaction is happening, right? So we are always doing it after the transaction happened. So at times, we have a limitation that not everything which we do in our audit could have been detected. And more so, it becomes critical when it comes to compliance with laws and regulations which do not have a direct impact. And again, we'll go through that in a minute. This is just an emphasis point over here. An auditor is not responsible for preventing non-compliance. It is management's responsibility to prevent and detect. And it cannot be expected of us that why there was a non-compliance of laws and regulations. It's quite unfortunate that many a time when there's a business failure or a corporate failure or there's a breach of law, many times those charged with governance or even the external stakeholders, they will look at auditors and say, oh, what are the auditors doing? But I think it's important that we always keep clarifying that it's the preparers of the financial statements who are the primary responsibility. Our responsibility is to do audit and provide reasonable assurance. There could be situations, as given in this point, there could be situations where we may miss something, but that's not because if you design the procedures appropriately, it should be still okay because we can't do 100%. But it's important to know that we are not responsible for ensuring, for preventing non-compliance. So I think the potential effects of limitations, right? We spoke about this. This is something which is very real life. If you look at the first point, there are many laws and regulations relating principally to the operating aspects of the company. They do not affect the financial statements and are not captured by entities' information systems related to financial reporting. So let's take an example over here. For example, if there's a company, as I gave the example of the chemical company, right? There could be a company which is having a plant somewhere in the interior of Maharashtra, and they have a factory over there. And the factory is located probably in an industrial area, or they are located close to maybe a river. Now, in this situation, how the factory manages the effluent waste vis-a-vis the ecosystem around it is very critical and essential for the operations of that plant. If you just sit back and look at how we would audit that company, we would not be looking at any financial impact coming through directly in our audit, because it is more to do with an operational aspect and may not necessarily flow through the company's ERP and on how the compliance was done. So this is one example. Likewise, if you take another example, maybe it's an e-commerce company. And in an e-commerce company, you have to comply with, say, a PN2 regulation, which says that, how a foreign company can operate in India, and who's doing retail, who's doing marketplace. Now, these aspects are not covered in companies' financial systems. They are typically captured in companies' documentation, in the board minutes, or elsewhere, but not in the financial system. How would an auditor be able to detect that? It's also important then over here is we should be able to understand the company's business and understand what is applicable to them to be able to understand the impact. The other aspect why we have a limitation is because of non-compliance may also involve conduct designed to conceal it. So many times what happens is that suppose there's a non-compliance which is not having a direct impact. It may so happen that you were not even informed about it, because maybe you asked the question, maybe you didn't ask the question. Maybe you asked the question and someone gave a very simplistic response. Maybe the response was to be fairly detailed by the company. But there could be collusion, there could be forgery, there could be deliberately failure to record transactions, there could be management override of controls, and there could be misrepresentation, as I mentioned. If the auditor is asked a question and is not been given the right response. So take the same example of that chemical company. Today, if you ask the CFO of the company that, we are completing the audit of this company for March 24, did the company have any notice coming in from any regulatory authority as it relates to environmental pollution? And the CFO says, no, nothing has come through. You will probably take a representation on that. But over there, the question is that should the inquiry be to the CFO? Should the inquiry be to the operating people? Should the CFO ask the operating person before he responds to us? Should the internal audit also look at the compliance when they make plant visits? If our team has gone to the plant for doing a physical verification of inventory, did our team make inquiries with the local people over there on such aspects? So if you look at the scope of this, it can become very, very wide. But it's always important that, because we opine on financial statements and we also look at materiality, we are always, as auditors, alert to this, that there could be a potential issue, but not every issue may have a material impact. So important point over here is to ask the right questions, be aware of the issue, but it's not necessarily that everything which is a non-compliance will have a significant impact on financial statements. It could be a small monetary penalty. It could be also at times a regulator will come and say, please rectify it and move on. So there could be many consequences, but it's not necessarily that everything has a material consequences. The key being, we should be aware of the issue and not necessarily not being even thinking about the issue. And last point on non-compliance with laws and regulations is that, we have seen in our experience, many a time what appears to be prima facie non-compliance with law may not be non-compliance with law. There could be an interpretation, because at the end of the day, these are regulatory matters. There could be an interpretation issue. And there could be many times a benefit of doubt given either by the regulator or by the company or by the courts. So the determination what constitutes non-compliance is ultimately for the court of law. So I think we have to be clear on that as well, because one thing which also comes at times as auditors is that, are we supposed to form a view? The answer is no. We should not be sitting in judgment on laws and regulations if it's to do with if it's to do with the operations of the company, because we are not the legal experts over here. But it's important that we detect the issue and we address it appropriately in the audit. And we come to the audit responsibility in a few minutes. But it's important that we are clear on this, that we should be very, very alert to identifying the issue, but we don't have to sit in judgment on whether it's a non-compliance or not. It is at the end of the company's assessment. It's a legal counsel assessment if the topic is complex. But I think we have to only ensure that if it has a bearing on the financial statements in terms of accounting or disclosure, we have done appropriate responsibility over that. That is our responsibility. I think in closing on this point, the further removed non-compliances from events and transactions reflected in financial statements, the less likely the auditors become aware. I think we spoke about the point of the example of the chemical plant, and likewise there could be many more examples where if it is not there in the financial statements, then for us it's very difficult to detect unless we have a very good set of the understanding of the business and we ask the right questions. So we have to ensure that we address the risk of the unknown, as I call it, in responding to laws and regulations. So I think the standard distinguishes the auditor's responsibility in relation to compliance for both categories. So when it comes to category one, it's with a direct impact, we have the standard prescribes what our responsibility is. When category two, again, where there are other laws and regulations which do not have a direct impact, the standard talks about what we are required to do. And I'll walk you through that in a matter of detail in the next slide. So if it's category one, where there's a direct impact, then it's like any other account caption which you audit. An auditor is required to obtain sufficient appropriate audit evidence regarding the compliance with laws and regulations. So I think that's quite straightforward. It's like any other account caption we audit. So it may involve testing of controls, it may involve substantive testing, it may involve looking at documents, looking at payments. Very simple because there's accounting entry in the books. It's easy to kind of, we understand that very well. Category two, as I mentioned, is where the trick is. So for category two, which where the impact is not direct on the financial statements, which is more on operational aspects, I think we are required to undertake specific procedures with laws and regulations. I think first one is certainly inquiry management. I think I mentioned to you that because of the risk of unknown and the risk flows of company's financial statements, it's important that we have a good understanding of the company's business, the applicable laws and regulations, at least the material ones, and we design our inquiry procedures towards management and the board in a very specific way. So, and this is where this is your first step as per the standard. You have to make appropriate inquiries with management, those are governance. Second, inspect correspondence with regulatory authorities. This is again, I mentioned to you that if at all there's a proceeding against the company, even in a remote location, there would be some documentation the company would have received, either an email, either a letter. I think we have to ask the right questions because it's not that every time in a remote location, the letter could have moved to the head office. We as auditors have to be alert to, okay, where the company's plants are, and at least ask the questions if they have received any regulatory correspondence or any communication by regulators. This is a good starting point to see if there's any formal inquiry against the company. Many times, the regulatory authorities could have also just inspected the company's premises and not really issued any communication. Those are the questions again to be asked of management, because at times it may there could be a time lag between the inspection and their letter to the company or correspondence to the company. But it's important that we as auditors at least ask those questions. That were there any regulatory authorities who visited your premises? Did they inspect anything? Were there any observations? Is there any communication? Those questions are very important to have. And last is other procedures. These other procedures are not, again, I have some examples for that. I'll walk you through that. But other procedures are what we do in our audit, right? In terms of, looking at impact of, indirect impact of transactions. For example, I gave you the example that there's a fraud, then does it impact GST? And that things like that. Maybe like inventory, right? Maybe the inventory doesn't exist or inventory has been stolen. So question is, how do the inventory move? And likewise for labor laws. If somebody is saying that the company is not paying overtime, now that not paying overtime could be a simple labor law complaint, but It could have a financial impact if the overtime accrual is to be done, right? So other procedures will be dovetailed based on what you see in your audit as such. So again, this is all coming through from the standards, so I'm just relaying that. But I think I have some more examples as to what an auditor should do in terms of detecting this. So I think this is something which is pretty much spelled out in the standard, but it's important to be alert. So when you look at design your other procedures, you always can incorporate steps which help you identify issues of non-compliance. And next point is on skepticism. I think this is a given. We have to ensure that we maintain professional skepticism in looking at compliance. The reason I'm saying we have to be skeptical over here is that many a time, because this is not our domain expertise, there's a tendency to rely, and it's not incorrect, I would say. So, as I said, if it's an immaterial aspect of the financial statements getting impacted, you probably would even rely on management representation. But if it is a area which is complex, and say a company is going to external counsel, all the more we should be more skeptical. Why would the company go to external counsel? They go to external counsel because A, there's a claim received, or there's an issue which is significant. So the company is taking legal help. But I think we have to be alert to such indicators. More often than not, when an external counsel is appointed, then there could be a risk which would be slightly significant than what you would otherwise see. If the risk is not significant, the company would not appoint an external counsel. They would typically then manage it internally. In some companies where they have a good legal team, they would still do it internally. They may not go outside. But we should again make the right inquiries with the compliance officer of the company to understand that were there any issues. So remaining skeptical, remaining alert is very fundamental, very critical when you're looking at indirect impact to financial statements. So having understood what our responsibilities are, I think we now look at auditor considerations. And this is where we talk about procedures and what other things can we do in auditing this aspect of compliance. So I think if I look at SA 315 in terms of looking at risk of material misstatement, I think there is a very fundamental need and requirement of the auditing standard that the auditor shall obtain a general understanding of the legal and regulatory framework applicable to the entity, industry, and sector. So, many companies have sectoral requirements like banking, asset management, insurance, telecom, media. They have sector-specific requirements. So, having an understanding of which laws apply to our client is the first fundamental point in identifying the risk of materials misstatement in an audit of financial statements. And this is coming from SA 315. So if the auditor has understood the applicable laws and regulations, then the auditor has to start looking at how do you then look at the implementation of that, right? The risk of that to the financial statements. So one important, again, element over here is that if I were to look at any of our clients, even if they're in a simple plant or a simple service company, if I have to kind of start looking at the various laws and regulations applicable to them, they run into hundreds. Even a simple factory could be having 30, 40 laws if I have to add all the applicable laws to that location or the geography, depending on which state they are in, which industry they are in. But as auditors, do we need to know all the laws and the regulations? Answer is no. And that's where it's extremely judgmental. Experience in an audit is very critical. And there's a judgment to be made which laws and regulations are important to us to address. Because if there are 50 laws, you can't address 50 laws because our primary responsibility is to give a true and fair on the financial statement, is to give a reasonable assurance on that. We are not here to give a report on compliance with laws and regulations. We have to consider laws and regulations in our audit. So we have to have that big picture as well to say that this is not the only thing to be focused on. But if anything comes out of here, then there could be a material impact, address that risk. So I think important to understand the legal framework, but focusing on materiality and the key aspects which impact the company. So how does the auditor see how the legal and regulatory framework is being addressed? Is what processes the company has. As I said, the management responsibility is to introduce the policies and procedures and processes. Auditor is to see what processes they put in place to identify the requirements, controls established, and periodic monitoring. So we as auditors are required to see whether the company has a proper process to identify, establish controls, and monitor them. We don't have to do it ourselves, but we have to look at the company's process. So this is very, very critical because this is again when it comes to understanding the entity level controls when you're issuing an opinion on internal controls over financial reporting. One of the key aspects of entity level controls is this aspect of what processes the company has to look at laws and regulations. I think the ICFR aspect, I think I'll just touch upon like in a few minutes. I think in the case of listed companies, for the management and board, the scope is internal financial controls. So the scope is far wider. For unlisted companies, the board's responsibility is only for internal controls over financial reporting. This is a far narrower one. For auditors of listed companies, for us, our responsibility is on ICFR and not on IFC. What I want to kind of clarify over here is that the management responsibility is far wider in establishing controls over their business operations as compared to our reporting responsibility under ICFR and the Companies Act, which is purely on internal controls over financial reporting. So our responsibility is limited to that extent. So I think we spoke about direct impact. I think obtaining sufficient appropriate audit evidence. I think that's something which we, as I said, we've been doing that in our audits. So we have to complete that aspect. And I spoke about inquiry management, those other governance also. That's very critical to have the right questions to them. I think we are also required to do additional procedures. As I mentioned that, we spoke about these two are mentioned in the auditing standard on making inquiries and inspect correspondence. But as auditors, we also have to we have to obtain information and remain skeptical. So, reviewing the internal audit reports, we do that in our audits to understand if they picked up any issue with non-compliance, reviewing minutes of management committees, inquire, obtain, and read whistleblower complaints. This is a requirement under CARO as well, because you have to give an opinion that all whistleblower complaints have been addressed by us during our audit. So this is fundamental to what we do in our CARO. But at times, the whistleblower complaint also throws up an issue related to fraud or non-compliance with laws. I think we have to kind of look at those complaints as well. And lastly, you have to remain alert to the information available in public domain. I think just the way company gets information from public domain, we have the same resources available to us. So I think it's important that when we are auditing a company, we are alert to what is being discussed in the in the press and social media. Again, this is something which is an ocean, right? In terms of what is there in the public domain, we have to also measure our steps after we are aware of something. So just to give you an example, if somebody's put a frivolous complaint on a company, or if somebody has just put a news article in the social media, that doesn't mean that the company is wrong, right? We have to have that skepticism. We have to have that balanced mindset to ensure that not everything coming negative is a negative for the company. Maybe it's a false news, but we have to be alert to it, right? So that's the objective which we have to go with when it comes to looking at information in public domain. We also should appreciate the fact that companies do very well or they are listed. There's a tendency for competition or some antisocial elements to, put a bad name for the company in the public domain. So we have to be alert to that aspect and not necessarily look at something which is negative and start thinking with a tainted mind. I think short seller reports is one of the things we see in the developed world coming more often, where there are companies who short sell stocks, and before they short sell stocks of listed companies, they would do a research paper on that company saying the company has a issue with their governance or issue with their transactions. Again, this is a way they're doing a short seller report for their objectives, but many a time it could be also leading to an audit risk. So we have to be alert, but we don't have to get carried away with every short seller report. We should read it, but we should form our own view. We are the closest to the company, right, as auditors. So we should be mindful of that, not necessarily start believing what others are saying without any audit evidence. I think these are some things which are very important for us as auditors. And again, one of the considerations for us is that ensure that our engagement letter has appropriate acknowledgement of management's responsibilities. So I think this is very fundamental and critical. I think the preparer is more responsible for the compliance and not us. I think second point is very, very critical. And this is where I see many a time lots of issues. So, an auditor, when they make the inquiries with management, that's one aspect coming in the covered in the auditing standard. But it's important to have appropriate communication channels and protocols. So if the company is a listed company, then you'll be doing a quarterly review for the company. But if your company is an unlisted company and you're not doing a quarterly review, you'll meet the company only once in a year. So it's important that there's appropriate communication channel set up with the company, and it doesn't take too much time, right, for making inquiries or for doing like an interim audit. It doesn't take too much time to just going and spending some time in the month of, say, December or February for a March audit and discussing with the company's CFO or the compliance team, is everything okay, reading the reports. I think that helps you to ensure that if there's any surprise coming up, it is dealt with appropriately. So have that appropriate communication channel. I think also request management to let you know. So it's also not only we inquiring, we should have management tell us that if you have any instance in the next 6 months, 9 months, please let us know at the earliest. So putting an expectation of that. So I think obtain notifications timely. Look at the information coming to their attention. If the company has received a significant complaint, or the management has picked up a significant issue in the company, or they've received a whistleblower complaint, if the company wants to do a investigation of that, then do engage with the company or tell the company to let you know at the earliest, so that you participate in that investigation, such that you're able to expect the results to your satisfaction when they come. I think, again, this also at times leads to issues to do with laws. For example, if it's to do with compliance with the FCPA Act or the bribery and corruption, an investigation may throw up issues which are impacting companies' compliance. And also, I think any failure by the company to provide information could have an impact on your accounts, right? So in case the company doesn't give you the right information at the right time, it will impact the sign-off. It will impact our opinion, and we'll discuss that in the reporting section. But again, it's critical that the communication channels are well established and expectations are set well ahead in the year, so that there's no surprises coming at the last minute. And I think I spoke about this. When you're doing an audit, remain alert to the possibility that there are other audit procedures. For example, testing of expenses, indicating fines and penalties paid, testing of transactions where the non-compliance laws and regulations. These are very simple, intuitive points which take you to compliance. Yeah. Last but not the least, request for a written representation from management that all known suspected instances of non-compliance have been disclosed to the auditor. So I think once you make the inquiries, complete your audit process, towards the end, obtain a specific representation on this. Because as I said, it's their responsibility as such. Audit procedures, I think I'll just put this out. Again, what we generally do is that when we see any non-compliances identified or suspected, firstly, understand the nature of the act and circumstances. Again, I'm just making this that first we have decided that it's significant, and then hence we'll do these steps, right? So I think first is understanding the nature of the act, and second is further obtain information to evaluate possible effects on financial statements. If the effect on financial statements is not expected to be significant, as auditors, we can maybe not spend too much time then, take appropriate representation, not design some procedures. But if we see a significant impact on financial statements, then we should start discussing with management, and if required, with those charges governance. So I think we should then figure out if it's a significant item, then they need to, the company, management, or the board, they need to provide us information which supports the compliance. And, we have to then, based on the information they provide us, form a view whether there's any material impact on our financial statements. I think the standard also envisages that in case required, the auditor can also seek legal advice. So either we ask the company to obtain a legal opinion from a counsel, or we appoint our own counsel to get the opinion. This happens rarely. More often than not, we have the company's counsel give us an opinion, and then we assess the competency of the management expert to rely on the opinion. If sufficient information is not available, cannot be obtained, then evaluate the effect on the audit opinion. I think that goes without saying. It's like a normal scope limitation then, and we'll address that in the reporting section. But the procedure we have to perform is, understand the issue, assess the financial impact. If it's significant, then management should we'll discuss with management, let them get information for you, and if required, get a legal opinion. And lastly, if you don't get the required information, then evaluate the impact on the reporting. When we see an impact on the when we see an impact on non-compliance, we should also go back and look at our risk assessment process. So many a time when we identified fraud risk or significant risk, we would go with a certain presumption. But after you do your testing, if you see any non-compliance coming through in a transaction processing or wherever, then we should go back and see whether the risk assessment for the audit is appropriate or not. And more importantly, also look at reliability of written representation. So if the company has withheld information, say in a given year, and we are completing the audit and taking a representation, effectively, if you are aware that the company withheld the information, then can you rely on the company's representation for the other areas? That is a question we have. Again, in practice, this becomes a dilemma for auditors. But at some point in time, we have to have a candid discussion with the management and reset our expectations if we see that anything has been withheld from us. I think we have to look at impact on our representations as well when we see that the company has not complied with laws and regulations. I think the standard says this, but there could be situations where we would take appropriate action by report modification or doing a discussion of those sorts of governance. There also could be a withdrawal from engagement in exceptional circumstances. So there could be some situations where the impact of the law and regulations is so significant that the auditor cannot issue opinion. And we've seen that at times happen in, say, in NBFC, or where the company not taken RBI registration, but they are actually an NBFC. How does the auditor issue opinion on that account? Because you cannot assess the financial impact of that. One of the RBI says that you have to get a registration before you commence business. You don't have a financial impact for that, right? So there could be some situations where auditor may decide to just resign rather than issuing an opinion, unless the regulation prohibits the auditor to issue opinion. And if that be the case, then the auditor has to then consider a disclaimer. Yeah. So I think this is something which is quite fundamental, nothing new. I think every aspect of what we do in our audit has to be documented. We have to document our findings for identified and suspected non-compliance. We have to document the effect on thereof on our financial statements. If at all, as a part of our audit process, we have obtained information from management, we would then keep those copies and supporting documentation on our records. We don't have to get everything on our files. You can make file notes as well. But it's important that if there are any key documents which you think is important for you to keep on your audit, you can do that. Many a time, legal notices and stuff, the company also may be hesitant in sharing, and which is also fair, because we are not supposed to have all the records of the company on our files. So we can make file notes as well. But we need to have appropriate documentation to support what we saw in that notice, what the notice said, date, people, and all of that. I think as long as the documentation reflects what is there in the document, that's fine. And last but not the least, I think this is something which we are not doing well. And we've seen some of the regulatory inspection orders, minutes and discussion with management and those types of governance and external parties are not generally documented well. I think just the way we do our audit documentation for where we have sufficient appropriate audit evidence, for example, testing of payroll, testing of revenue, I think we all document that appropriately. When we interact with management, when we make inquiries for such important areas, we have to minute these discussions with appropriate reflection of date, time, who we met, who said what are the follow-up questions, what are the final conclusion, what is management's feedback, what are the action steps. It's important to minute these meetings. And more importantly, when you're talking to the board or the audit committee, because they are also at times sitting at a distance from management. They are seeing it from and it's important to get their perspective as well. And lastly, when you're dealing with the external counsel, So, an external party mentioned over here is external counsel possibly. So the company's appointed a legal counsel. You may request access to the legal counsel, and you may meet the legal counsel and understand the issue. And once you have understood the issue, along with the legal counsel opinion, you may minute that meeting. That as an auditor, you did that meeting. This is what you understood, and this is the way you can do it. The very critical aspect of whatever we discussed until now, because the very common phrase, right? If it's not documented, it's not done. That is the challenge we see with this. So document whatever you've done in the entire process. Coming to reporting, I think again, yeah. So communicate matters involving non-compliance with laws and regulations. You have to communicate this to those charged with governance, the audit committee and the board, and if there is any other committee which they have created, risk management committee. I think the caveat over here is, what if the board is involved or management is involved? I think the important is this is very, very critical, because at times if the non-compliance with, say, the company's license or the company's regulatory approval, the board will be aware of that. One should assume that the board is aware of that. And how do you deal with that situation where the auditor knows that the matter is so fundamental that the entire board is aware? So I think it's important to have that communication, to do a discussion with those charged with governance, understand, is there an intentional misstatement? Is the non-compliance intentional or is it unintentional? Also, form a view whether it's material or not, and do this communication as early as possible, because, as I said, this can impact at times your ability to sign off the accounts. And I think we have to also evaluate this. If the auditor suspects that the management or the committees are involved, then can the auditor go to the next level authority? Maybe the board of directors, maybe the audit committee, maybe supervisory board, if they have one. So one has to evaluate that. And again, these are at times very rare situations, but they do happen. That the person implicated is a member of the audit committee or the board or the entire board. Yeah. So if there's no high authority which exists, then the communication, the auditor should consider need to obtain legal advice. So in case we are unable to talk to anybody in the company, then the auditor should get legal advice for the auditor to decide whether the auditor can continue to issue the opinion or not. I think this is also pretty much our responsibility. So reporting to regulatory and enforcement agencies. So in case we see a non-compliance with laws and regulations, do we have any obligation to report? In some cases, yes. Of course, we are aware of the reporting responsibility under 143.12 when we come across a fraud in the course of our audit. But beyond that also, if you see a fraud which has an impact on laws and regulations, will get covered over here. But we should be mindful of the fact that we have responsibilities to report to external people as well. I think one of the fundamental aspects of audit is confidentiality, right? And we have to be alert to this. So when we are discussing non-compliance about a company, we have to be mindful whom we are discussing with. So I think we have to be very, very careful because this is a very sensitive area which can impact a company's reputation, and also it could also impact our objectivity, independence, and it could reach a code of ethics. So we have to ensure that we maintain confidentiality and be mindful of who we discuss these issues with. Many a time, if you want to consult, maybe you can consult with the legal counsel because you have privilege over there, but ensure that it's you don't have to kind of call out the names. If you're taking informal advice, you can do without name calling, if the name calling is also not apparent. But it's important that you be conscious of how you discuss these topics outside your audit team. In some jurisdictions, legal responsibilities, the confidentiality is overridden. Auditor of financial institution has a statutory duty to report occurrence of a suspect of non-compliance. For example, the non-compliance with the RBI requirements, then you're required to report that in your RBI report. So that is something which is fundamental to our reporting. But I think the issues could be, there could be other matters which are not as clear as RBI requirements. We have to form a view on that very, very carefully. This is quite straightforward in terms of what we do. So I think in case the non-compliance has a material effect on the financial statements, then and the company is not recording the necessary adjustments, it could be a qualified report. And likewise, it has not been disclosed appropriately. So we also evaluate that if the amount is significant and pervasive, then is it a adverse opinion? That's the evaluation to be done as per SA 705. If it's a information not produced by the company, so many times the auditor is not provided information itself. It could be for two reasons. It could be for a reason where it's outside the company's control, or at times the company has it but they don't want to share. In that case, the auditor has to form a view that does it lead to a scope limitation. If it leads to a scope limitation and we assess it to be significant to our audit opinion, we will consider a qualified opinion. Again, if the scope limitation is considered to be significant and pervasive, then we would consider a disclaimer. I think in some situations where we are unable to withdraw from the report, withdraw from the engagement, then the auditor can consider even putting a disclaimer before considering a withdrawal. And we have to evaluate on the auditor's opinion the limitations which we have as such. So this is something which is more on the reporting side of it. So I think we've covered a fair bit of the standard in terms of looking at the objectives, the definition. We spoke about management responsibility, auditor responsibility, and reporting. What I'll do now is spend just a few minutes to walk you through a few examples. And these examples are such that, as a in the course of our audit, we come across issues and we have to assess, the indirect impact on financial statements. And as I said, it's very judgmental. So I put a few examples over here, and maybe we can go through these and see how to address some topics. Because it's a webinar, I'll probably share with you the response as well, and it's all dependent on case facts. The responses are generally based on case facts. So, but I'm just giving you these examples to provoke a thought as to how do we see these topics. So in this case, a very simple one. Jubilee Capital Finance Limited is a listed NBFC registered with the RBI. You are part of the statutory audit team, right? That's a simple one-line fact pattern. Now, if we are sitting back and understanding the company's business, we said that, right, under SA 315, we are required to understand how laws and regulations impact a company. What is the first thing which comes to mind when you see this line, right? So when you look at laws and regulations applicable to it, you would start thinking through, right? Oh, it's a listed company. So SEBI regulations, then NBFC, RBI regulations. It's a company, right? So corporate law. If you extend that, direct, indirect tax goes without saying. And anything else, maybe RBI regulations for NBFC, but also exchange control regulations, anti-money laundering, things like that. So just by looking at one line and having a good understanding of the sector, you should be able to kind of at least understand what are the broad laws and regulations that the company has. So I think So I think labor laws, again, employees will be there for sure. We spoke about Companies Act, tax laws, PMLA, money laundering, if you're in that business. Deposit Insurance and Credit Guarantee Corporation Act, and NBFC, that will be again applicable. SEBI we spoke about, FEMA we spoke about, RBI. So that's the broad approach. When you see a company's industry and its profile, you should be able to identify the broad laws applicable to it. This can get certainly complex if you're talking about a manufacturing company, a geographically dispersed company, and the challenge multiplies if you have different jurisdictions. Just imagine, I'm talking about a single company where you can do this, but if you have if your audit clients are having components or businesses outside of India, then the entire dimension changes. So we'll do a quick rundown. Again, I just listed some examples over here. So, employees arriving late or early or leaving early. So suppose there was a complaint somebody put in that the employees are arriving late or leaving early. Does it constitute non-compliance with laws and regulations? Possibly no, because unless there's a law which defines in terms of working hours and it's to do with say a female employee. Otherwise, if there's no specific labor law which prevents, this is not generally a non-compliance with laws and regulations. Employee conduct. So employee is not being tidy in office, or employee uses offensive language or dress code violations. Now, this is very, very real life, right? Employee conduct is behavior, is personal misconduct. And we discussed in the beginning that personal misconduct, which doesn't impact business operations, is out of the scope. So this is one of those, right? So this doesn't impact laws and regulations, but it can certainly impact the company's environment. So it may not necessarily be an issue with non-compliance with laws, but it may be non-compliance with code of conduct. And hence the company should deal with this topic in that manner. Complaint about level of overtime, supervisor attitude, or minor company policy violations. So at times there could be a whistleblower complaint that we are not getting paid overtime. This is the impact area when it comes to labor laws, because labor laws define what is the number of hours to put in. But if it is to do with a category which is not falling in worker category, but in some other category, which is not covered in the labor laws, then there will be no law or regulation impacting the company. Likewise, attitude we spoke about, or minor company policy violations, they may not necessarily, so there will be non-compliance with laws and regulations, but they may be minor, so they may not have a material impact. So the evaluation has to be based on the fact pattern, but also checking if there's an overtime issue, is there a law which gets breached or not. The inquiries have to be made accordingly. Payment of dividend using funds that are received from use of dividends. A clear case of non-compliance with law, company law. That if you're paying dividend from restricted cash, that could be a clear non-compliance with laws and regulations. Again, you cannot see the financial impact directly. You have to do it through the part of your audit process. That was there any restricted cash used to pay or not. Notice received from tax authority. I think it's quite straightforward because the tax authority is saying that you have paid short paid taxes. That clearly is a non-compliance with laws and regulations. Whistleblower complaint for bribery and corruption. I think this is very, very sensitive again, very, very difficult to at times conclude, because bribery could be for furtherance of the company's business at times for promoting sales. Bribery could be for probably somebody taking undue benefit, not benefiting the company, and same with corruption. I think important point over here is in the bribery and corruption, was there any law breached? I'm referring to the standard over here. As a code of conduct, this is a significant issue. I'm not discussing that today. I'm focusing on laws and regulations. So does a simple incident of bribery and corruption impact laws and regulations? It depends on facts and circumstances. So please go deeper into understanding, was there any breach of law or not? And likewise, whistleblower complaint of favoritism procurement. So, at times you get a complaint that XYZ vendor is getting favors by this procurement manager. That may be, again, a code of conduct issue, may not impact the law and regulation. But if the procurement is with the government agency, then you have to again think through, is there any compliance with Prevention of Corruption Act? And that's where the auditor's understanding of the business becomes important. So we have to look at the incident and start framing a question for that incident. And likewise, it could be favoritism in hiring of mid-level executives. It may not impact the laws and regulations, it's just a code of conduct issue. So I think these are some examples, which we come across in terms of our day-to-day operation, day-to-day work. All in all, I can tell you there's fair bit of judgment involved over here. So being alert, identifying the issue, and more important, not getting worked up about the issue, because you can take support from external help, you can go to companies counsel, you can talk to professional colleagues, maintaining confidentiality. But it's important that we are alert to the issue and not necessarily ignoring the issue completely. Coming to summary, I think I've captured just 3 points over here. So laws and regulations are a very complex area. I think it can range from minor fines, penalties to implications on management or those types of governance, or it can also result in cessation of a part of the or of the entire business. It can range from anything, right? From very minor to very major. So, second bullet point is for auditors who are issuing opinions on entities which are not in the Indian jurisdiction. In India, we understand the law, generally speaking, but we don't understand laws outside of India. So I think if you're or issuing an opinion on any US company or a UK company, I think we should be very mindful. Do we understand the laws and regulations in those countries? And I think this is where we see at times challenges come through because you may issue an opinion without understanding the legal requirements in the country. And last point is you can place reliance on legal opinions written by the company after considering the competency, capability, and objectivity of the management's expert. So it's not that we have to keep running behind external counsels ourselves. The company's got a legal opinion, you can rely on it. So I just try to capture whatever we discussed in the last 1 hour or odd into this one slide. I'll have the slide made available to all of you. But in summary, when you look at laws and regulations, I think important is gain an appropriate understanding of the industry or business of the company. I think if the business is regulated, then we should understand what are the applicable regulations. Understand the management's controls for compliance with laws and regulations. Develop audit procedures. I think it's important that we ensure that we are alert in designing our procedures. Reviewing communications regulators. Reviewing minutes of meetings. Making appropriate inquiries with management. Reviewing legal expenses. If you know the lawyer has been appointed, then there could be a potential issue. That's the way you go about picking up an issue over there. And if you have an external counsel, understand the matter and its potential impact, and interact with the company's legal counsel if considered necessary and upon your own. So this is what I have kind of captured as more takeaway. And last point, again, as goes for anything else in our audit, remaining alert, right? There could be regulatory changes coming through. Company may not be aware, but we should be at least alert if we're auditing a company in terms of what changes are impacting that company. So with this, I have kind of come to the end of my presentation. Gaurav, I'm going to be requesting you to let me know if there are any questions which have come about.
Yeah, sir, I have a few questions.
Yeah.
First one is violation of POSH in business premises personal misconduct, although companies have to ensure compliance?
Yeah, very specific question. So my specific answer is yes, it is a non-compliance with laws and regulations, but it doesn't have a direct impact on the financial statements. So it may have an indirect impact that the company may have to have any consequence management on that employee. It may have to appoint a legal counsel and go through a process, but that's the indirect impact which comes through legal fees. But POSH per se is not one of those items which has a direct impact, which has a financial reporting impact. One important point over here, Gaurav, again, because you're giving me limited facts, I'm giving you more color to the response. I think it's important who is the alleged person in that POSH complaint. So if the person is junior level, mid-level executive, it's different. If the person is at a senior level, probably a KMP, then the risk, although it's my answer will not change on the laws and regulations. It will only impact how much reliance can I place on that then. If it's okay, I'll just stop sharing my screen, then we can probably do it. Yeah. Yeah, Gaurav.
Sir, while verifying the employee records in a company, it was found that a major portion of labor employed was child labor. On questioning the management, the auditor was told that it was outside the scope of financial audit to look into compliance with other laws.
So if I rephrase the question, the company is employing child labor.
Right.
And was there any consequence of that?
Not necessary. The question doesn't say so.
So if the company is applying child labor and child labor as per that particular establishment or that particular sector is prohibited,
right,
then you clearly have a non-compliance with laws and regulations. Now over here, there could be 2-3 issues.
Right.
One issue is clearly it's a non-compliance. Question is, what are the consequences of that? Is there a fine, penalty, or is there a shutdown?
Right.
I mean, it could be a range of consequences over here.
So it can impact the going concern as well.
Absolutely. Going concern, and before going concern, you hit the impairment, right?
Right.
What do you do with that investment made in that plant, and what happens to, And what happens to the so depending on the in fact it can become reputational, Gaurav. I would say it will be a significant impact. So I'm just thinking aloud. As I said, limited case facts, but I'll
Right.
give you my broader perspective. First thing is, if the company was employing child labor, was the board aware? Was it as part of their budgeting and planning? Did they have that? So,
Right.
question is the whole company embroiled in this?
Right.
And the answer can change. It can have a significant impact on everything we discussed.
Right. So the last question is, the auditor wants to be alert on possibility of non-compliance with laws and regulation during the course of audit of a company. The auditor seeks your guidance for identifying indications of non-compliance with laws. Basically, they're asking for a brief checklist sort of a thing, I guess.
Checklist. So, as I said, Gaurav, I will certainly make this presentation available. If you go to my presentation, there are some notes I put together as to
Right.
what I follow. What I follow is, firstly, making the right inquiries and ensuring that we identified all the issues. After you
Right.
identify the issue, assessment of the effect on the financial statements or disclosures. Now, all of that cannot be, honestly, cannot be converted to a checklist, because if you look at the number of laws which are applicable to a company, at least 20, 30 laws are applicable to every company.
Right.
So you cannot make a checklist out of that, but you can certainly, depending on, you should have a framework to approach the issue, which is what I put in my presentation. So if you follow the framework, you should get to the right answer, in my view. But you cannot make a checklist of saying tick, tick, done, done, done. That may not be possible to do in this such a diverse topic. It's a very
Right.
wide topic.
Right. So there are no further questions. So I'd like to thank sir on behalf of AASB and Anilji. Is Anilji available? Just check if Anilji is available. नहीं सर नहीं.
Can you hear me?
Yes, we can hear you now.
Yes, sir. Yes.
Yeah. Thank you so much, Govind sir, for such a wonderful deliberation. We have gained a lot through your deliberation, and you have covered all the questions also. From the core of my heart, as well as on behalf of AASB of ICI, I extend my heartiest thanks towards you, sir, for sparing your valuable time. And hats off to you, sir, in spite of having so many meetings lined up, and you have given your kind consent to deliberate on this very pious occasion of the Makar Sankranti. So thank you so much, sir, for your good wishes, as well as the insight, as well as the knowledge shared with our members. So I also thanks towards Gaurav Maniji for wonderfully coordinating this today's webinar. So on behalf of AASB of ICI, I also wish everyone and both of you happy Makar Sankranti and happy Lohri. So thank you so much, Gaurav sir. Thank you so much, Govindji. I also wish all the participants of today's webinar happy Makar Sankranti. Thank you so much, sir. Namaste. Good evening.
Thank you, sir. Namaste.
Thank you, sir. Thank you, sir.